Good afternoon. Congratulations, you made it to the last session. And I think we decided to have some fun and make it a little bit less formal than maybe before, and not sit down and be open. We're also going to split this session into two parts. The first part, each speaker will kind of talk about his own experience investing in Central Eastern Europe. And in the second part, we go to the Q&A. My name is Berend Yntema. I'm Managing Director of Clairfield International. I think we were selected to moderate this panel because we sold companies to DACH private equity in 2017 and to CEE private equity. And if you talk about this kind of exits, you have a complete different funds to address when you do the deals in DACH versus the deals in CEE. So I'm sure we get to that topic later on in the panel. I think we have a distinguished panel for you. We have from Pekka Mäki, who's invested in the region, I think, for over 20 years, still doing VC investments in CE mainly, but always also with an angle to DACH. Tomasz Czechowicz, thank you very much for joining us today. He's the founder of MCI Capital. He started out very small, and now he manages over 600 million in an evergreen fund. And we have Stypulkowski from EQT. EQT is one of the larger investors in Europe, and especially in DACH. Out of Sweden, they manage almost 40 billion. And Jan works for the fund that invests out of the mid-market fund, which is 1.6 billion. So he's on the larger end of the DACH investment cycle, and interesting to hear his views. And then we have Bill Corbett from CE Equity. CE Equity is a fund in Central Eastern Europe. And I think very interesting from that perspective is also that their money mainly comes from China. So that's a different way where money flows into the region. So welcome everybody, and Jan, I'll give you the microphone first.
Thanks, Berend. So maybe a few words at the beginning. We figured out it's going to be better that we sort of stand up and walk around, so you're going to be more entertained. I'm working for EQT. Joined EQT 7 years ago, and I have a benefit of actually going through both the large buyout fund at the beginning and then moving to the mid-market space. What's also quite interesting, at least for me, is the fact that I cover both the German-speaking region and Central Eastern Europe. So I'm based in Munich, but look at mid-market transactions in CE, predominantly in Poland, though, and also my portfolio companies are mid-market companies in Germany, also have some experience in Switzerland. Sometimes looking also at the Benelux. So we figured out that at the beginning, each of us will just give you a couple of minutes of their experiences and what do we think is relevant for the audience here in this conference. And for me, I think the key is just to emphasize the differences I see on daily basis in deal making between the DACH region and the Central Eastern Europe, because this is sort of something I switch on daily basis or weekly basis. I think there are three major differences. First probably relates to how you're organized. I think, and we can allude to it also later on in our discussion, but I think DACH space is relatively uniform and big enough that you're having increasingly sector-focused approach. I think more and more you have to look at particular sectors where you're becoming part of ecosystem, and it's either it's healthcare services, TMT, industrials. It's pretty hard to really be sector agnostic in Germany these days. There are people who are successful in it. I'm personally more of a generalist, but I think I'm also, me and my colleagues are more and more focusing on particular sector verticals. It's completely different in CE. In CE, I think the knowledge of languages, knowledge of locals, networks, and particular countries is still very important. So I think the first difference is being more sector-focused and having sector expertise versus being a generalist. Second, what I see is the type of companies you're buying, and maybe not that much the type of companies you're buying, but rather the preparation, the intellectual or mental preparation to selling the business when you have the process ongoing. And what we've noticed is in Germany, they're typically, if we buy companies, I'm not talking about buying them from private equity funds, but more buying them from entrepreneurs. These are either people who have been in the business for a couple of generations, and at some point they figure out they want to sell it, or these are relatively young people who established their businesses, they're well educated, made a success over the course of a couple of years, it grew, and then they sell it. In each case, they're very well, they have a very good understanding of world of professional advisors. They interacted with them over the course of years and so on. So those processes, once they go to the sale process, they know they really want to sell. There's less of discussion of the shareholder agreements, the terms of reinvestment and so on. It's different in Central Eastern Europe, which also creates some opportunities. In CEE, I think the major difference is that you basically very often have to create the deal yourself and sort of also walk the entrepreneur who's selling you the business through this process, because he typically built a business over the course of the last 20, 25 years, not having to interact that much with the, I would say, advisory community and process-driven community. And I think the third difference is really the type of exits you can count on. And there are some benefits in CEE. I would say for mid-market companies to list them on the stock exchange in Germany is probably, we don't do it. It's virtually impossible. But what you can do is, so this is the benefit of being, for example, in Poland, where the stock market is quite big, and there are players who are extremely successful listing their companies on a regular basis. What's an advantage in DACH is the fact that it's easier to get strategic investors, because they don't have to go through two different layers of decision making. It's not like you first have to decide you're comfortable with Hungary, for example, and then the industry. It's just the industry and the access to the German market, which is German, Austrian, Swiss market, which are pretty huge. So I think these are the three major differences I've seen and sort of that I'm seeing on a daily basis, creating some opportunities on both ends. So it's hard to say which one is better or worse, but this is something which we see regularly.
Thank you. Thank you very much. Bill, the floor is yours.
So we've just first finished investing our first fund, which was $435 million. We're moving on now to our second fund, which is expect to have a first close of $800 million in the next couple of weeks. And I thought, coinciding with this event, it was time to reflect on the type of deals that we did in our first fund, and how perhaps did they compare with what we thought we were going to do at the start. And I think this follows on a bit from what Jan was saying. I think top of our list in what we've been doing is succession-related deals. Often, as Jan has said, you have to do a proprietary one rather than wait for an advisor to call you. But I think throughout the whole of CEE, and our definition of CEE does not include Austria, so we're just post-communist CEE. Throughout that defined region of CEE, I think entrepreneurs typically want to exit. The kind of, I remember having discussions in Poland 20 years ago as to whether Polish entrepreneurs would go down the Anglo-Saxon route or the German Mittelstand route, and I think they've mostly gone Anglo-Saxon, and there's no real tradition of handing a company over to the next generation. Next generation want to go off and do something else. So yeah, succession deals have really come out top of what we've been doing. The next one was buying from private equity. And I think when we went into this 4 years ago, we imagined that we might do one or two deals buying from a smaller venture capital or private equity fund and taking companies to the next stage. In fact, we haven't done any of that. What we've done is two deals, secondary deals, from a similar sized private equity fund. And, there's always a question there. Is this just a pass the parcel sort of exercise? And I think we really have found that there is value still to be created by changing ownership, even to a fund of a similar size in both those deals we've done. The third thing we thought we would do quite a bit of is development capital. And in the event, the only real development capital we've done is in the renewable energy space, in particular financing wind farms in Poland. The banks seem very willing to lend in most countries in CEE, and so, I mean, certainly we're finding very little scope for private equity doing development capital type deals. The fourth one we thought we would do some of perhaps, and we've just done one, is restructuring the balance sheet, where the banks have overlent, and there's a bit of a hole to be plugged, and operationally the company is sound, but it just needs a bit of debt to equity, and we've done one of those. And I think the fifth area we thought we might do one or two is strategics, readjusting their portfolio. Maybe they dipped their toe into CEE and the water was too hot, wanted to get out. In the event, we haven't done any of those, and we haven't seen much in that space at all. So, my very brief sort of roundup of what we've done.
Thank you very much.
Good, thanks. So first of all, my name is Pekka. I'm managing partner of 3TS. We are a technology growth investor, normally investing sort of 3 to 10 million over the lifetime of a company into companies that do at least a few million of revenue. So we are not normally an early stage investor, but all of our investments are in the technology space or ICT space, mostly enterprise software and some internet plays, e-commerce and so forth. We have been doing this now as a firm for almost 18, 19 years. I joined 15 years ago, almost to date, and I feel like it would be yesterday. It was actually many of the same people in the room even, which I'll come back in a short bit. But I think that's one of the learnings, that the cycles come and go. But if you want to do anything significant, not buying and selling companies, which, by the way, the big guys do. They buy and sell companies. You heard about leverage, banking, gearing, all of that type of stuff. We are about actually helping entrepreneurs build bigger businesses. And I think that's what sort of excites us, and that's why we keep on doing this. So I think there's a fundamental difference when you are in the venture or growth space. It's a very different business from the big guys, and you know, I think both you can make money, but I think we are having a lot more fun. They might argue that making money is a lot of fun, but I think seeing small companies grow very big from a couple of million in one of the countries here in the neighborhood to 5 or 6 billion globally, it's pretty exciting. So I think it takes time, and that's the misconception. And I think my sort of humble ask or warning is that the things have been a bit too hot lately. You know, just there is so much excitement into the startup world, so much money going into various types of companies, and many of the companies, it's nice that people try, but actually it's highly unlikely that they will succeed. And now already the stock markets are very volatile. And we are seeing more and more pressure towards the high pricing. So pricing has been over the top in every which way, both at the high end and the lower end, both in venture and buyouts. I think there's a bit of a correction. If you look at numbers from Europe and US, maybe the last 2-3 quarters, pricing is coming down a bit, but way not enough. So I think there will be more. And once the air is a little bit out of the bubble again, then we'll see who has the stamina to continue and back the companies and continue working. So I'm unfortunately predicting that there will be a bit of correction. And I think that leads to my question to you guys. How many of you are actually investors into companies? So VCs or private equity houses that you actually invest in companies? Well, that's about 15 people. How many are entrepreneurs? Maybe a bit less, and the rest is advisors. So, yeah, advisors, all types of advisors, M&A, bankers, lawyers, what have you, which is great. But those are the guys that really enjoy when things are hot, because they make money every single time. When we go in, when we go out, when we need help, they make money. So they are in the best place. For us, obviously, you know, Tomek has been doing it for 20 or odd years. We have been doing it a long time. It actually takes 5 to 7 years to actually normally make money with the companies, and it takes 8 or 10 years to make money with the fund. So this is a marathon run. He's actually a marathon runner. He will talk about that most likely. So that's a thing that I would just ask all of you who love the hype, who like to be in the space, just continue doing it. And we'll make a raise of hands in 15 years from today, when I have my 30-year anniversary in CEE and DACH growth investing, and we'll see who is still here. Because this is very, very long-term business. And maybe to end this before I pass the mic to Tomek, I would like to introduce my colleague Elbrus, who is in the back. So Elbrus used to work for us in Istanbul, and now he's actually both here in Vienna and in Istanbul doing deals across the region. And it's great to have also him in the audience. And if you have any growth stage technology companies, come and see us here or give us a call. Thanks.
Thanks, Pekka, for this nice introduction. I have to say that Pekka is my oldest friend in venture capital industry in Center. We met probably 2003, I think, 2003, and 3i was 3TS was the first VC, professional VC being active in Central Eastern Europe. It was like, I think, 1998, 99 when VC started. I'm 30 years in technology. I was an entrepreneur. I started my first business 85. It was about floppy manufacturing and software. In 90s, I grew it up to the biggest piece manufacturer in Central Eastern Europe. And then 98, I realized that it's more fun to be an investor than to be an entrepreneur. I decided to switch, yes, and I started to run the fund. That was a first VC fund in the domestic VC fund in Central Eastern Europe. We went public, and we grew up since that from venture to growth, from growth to buyout. At the moment, we mostly focus on growth buyout transactions from 10 to 100 million euro. And we have experience across all the European markets, from let's say UK, Sweden, up to Tel Aviv, Israel, and Russia. Basically, grabbing this experience from all these different behaviors, different economics, etc. The topic is about investing, or let's say how is the business going on in German-speaking countries, DACH and Central Eastern Europe. We are quite active investor in both regions. We did like 6 transactions in DACH countries, and about, I think, 100 transactions in Central Eastern Europe that I will share with you a couple of my views. But maybe just before that, just to give you the understanding that like we are 1/3 in digital retailing. That's where we have a lot of experience. 1/3 is a fintech portfolio which we have. We are probably the biggest fintech investor from Central Eastern Europe. And 1/3 is the digital infrastructure. That's more or less the way how we grow our portfolio. The fund is around $600 million, and we are usually doing like 2 to 3, 4 transactions per year, with a major focus in Central Eastern Europe. I think in the past, where we've been looking at German-speaking countries, we're mostly looking at the situations where we could add value through being an experienced investor from Central Eastern Europe. That's happened, for example, with a company called As Good As New. That's the biggest electronic e-commerce from Berlin, where basically the company have a factory on the border between Germany and Poland, and we use the low-cost economy, or like lower-cost economy, and lower-cost development in Poland to basically get a strategic advantage. Yeah. That worked, yes. Another case was our investment into Windel, which is one of the champions in the baby product e-commerce, the 200 million euro e-commerce business listed on the Frankfurt Stock Exchange, which first expanded to Central Eastern Europe with acquisition of Czech Republic and expansion from that across the region. And then utilized again the effect of the lower cost services by moving some functional areas of this company to Central Eastern Europe, and having currently plans to move the logistic to Central Eastern Europe from Germany. And that's what we see everywhere. I mean, there's more and more, especially for the e-commerce industry, there's more and more players Western Europe, which are basically moving the operations to Central Eastern Europe, IT, logistic, basically all the western part of Poland right now is occupied by the logistics centers of Zalando, Amazon, and all these big players. And that's one thesis which I'm having, looking at that, is that I think the future of e-commerce the future of European e-commerce will be Central Eastern Europe, because I believe at the moment it's mostly back office, or let's say operations, being moved to Central Eastern Europe, but I believe in the future the East European e-commerce platforms will basically expand, and as we at the moment probably the Germans, they are the most successful. I mean, like, look at Zalando, look at Amazon is expanding from Germany across Europe, but looking at the amount of services which are basically being developed for these business models in Central Eastern Europe, I believe the future will be rather that the East European e-commerce platforms like Alibaba's or like JD.coms of Central Eastern Europe will be more and more successful, and it will expand toward Western Europe through acquisitions or through organic entry. And because most of the costs are basically the cost which could be delivered much cheaper in Central Eastern Europe than in West European countries. That's one of the views I wanted to share with you. That's maybe interesting, maybe not. We'll discuss it later. Thank you.
Okay, thank you very much. Any questions that need our immediate attention from the audience? Any questions for the speaker at this point in time? Guess not. So you were very clear then in your introductions. Let's talk a little bit about the differences in the region between DACH and CEE in terms of the LPs giving you the money to invest, because I think that mainly the difference is also why you don't get funds from CEE for a DACH company that you're selling, is just because the LPs have given you, and you have promised to the IPs to explore your money in a certain region, and that's why you're not investing it elsewhere, and so that's why you have different players to talk to. But I mean, on the other hand, Europe is growing together, and especially if you look at the economies of Poland, Czech Republic, and Hungary, that's not so far off more from other EU members. So, do you think this will change, and why is this from an institutional perspective still the case, Pekka and Tomasz?
Hello? Yep. Good. So the there's various ways you look at the LP investors. So the investors who invest into funds like ours. So there's first of all the perception that there's a higher risk in Central and Eastern Europe still, even if people are not really sure what they mean by Central and Eastern Europe. But there is a perception that there's a higher risk, so you need higher returns, so it's in the same emerging market basket with Africa and BRIC countries and so forth. So that's an issue, because if you compare the markets, Nigeria to Poland, that's not really a good comparison. So in many large LP investors' pockets, it's just a global allocation strategy in Central and Eastern Europe. Unfortunately, it's not really part of any region. They put it to somewhere in emerging markets, but then when you say that it's EU, they have a problem. And then they say that the pan-European funds anyway cover that, so why invest in Central and Eastern Europe? So that's one of the issues that for many large asset managers. The other issue is that there isn't really a lot of local LP investors in any of the countries, and that's the same for all of the Eastern European countries and, for example, Austria. There are almost now none of institutional investors with continuous programs. I think there's a few exceptions. Currently, PZU in Poland is building a program. They have done a few fund investments, and they are looking to extend that. Tomasz was here at least at some point, but so they are doing something. The Romanian pension fund, some of them are doing something. They have been doing here and there investments. Česká sporitelna, the Erste Bank's company in Czech Republic, has been doing 5 or 6 fund investments. So there are a few, but it's not like tens of pension funds. And as long as you don't have local LP ecosystem, the foreign investors don't come in. I mean, in a bigger scale. So if you have local LPs backing locally grown funds, then you have a lot of foreigners coming in. So basically what has happened is that 10 years ago, around 26, 27 or so, 11, 12 years ago, there were still about 150 to 200 LPs from outside of the region who invested in Central and Eastern European funds. And today the number is somewhere between 40 and 50. So that number has declined massively. You know, and it's not one investment somewhere, it's who has a continuous program and that the region is part of it. On the other hand, you see in the Germanic region that yes, there are some German funds who cover the Germanic region, but most of that is done by pan-European funds, be it then buyout or especially in venture. There are very few German funds compared to the scale of the economy. So there are some issues, and maybe the Polish gentleman can talk more about the Polish pension fund regulation, which is borderline stupid. Why can't they invest into the private equity asset class? Why are they forced just to go through the stock exchange? So there are regulatory issues, there is perceived high risk, and so forth. However, we now see a new wave of wealthy entrepreneurs who have sold their companies and want to put the money back into the ecosystem. Many of these guys have become angel investors. The same happens here in Austria, but in all of the countries across the region. But very few of them have actually gone and given 5 million into to a fund. They rather do it themselves because they believe they can do it better themselves. And they obviously built a big business, so they will be great investors. However, it's a bit more difficult than that. So I think we will have a backslash from that some of the people are disappointed with their returns and they will probably do nothing. So again, that's fueling a bit the early stages, but not going to real venture funds or real private equity funds. So it's good in the early stages, but not helping the growth or buyout states at all. So certainly there should be, in my opinion, regulation removed so that all types of institutionals, banks, insurance companies, pension funds could invest into the asset class. And there has to be a couple of local investors that create programs that are not just for marketing purposes. This year, let's make one stake. No, you have to spend 5 to 10 years creating the program, and you have to run it for 20 or 30 years really to have results. So I think it's going to take time.
Thank you very much. Tomasz, anything to add to that?
I think if you look at EQT was a Scandinavian private equity group which expanded first for the European market, being very successful in German-speaking countries, and then became a global. And that's something where Central Eastern Europe is lacking. Like, for example, there is a group called DST from Russia, and they became a global VC fund, a very successful VC and growth investors. And it's not really easy to prove that there is anybody from Central Eastern Europe which became a European or global investor. I mean, there's no full disclosure of the some family office groups from Czech Republic. Maybe they are more successful, but when you look at the Polish private equity and let's say venture capital and growth space, we are still very much regional. Yes, I mean we are good in Central Eastern Europe. And we try to be European, but I cannot say we are already European in terms of our track record. Yes, that requires a lot of skills and also requires a lot of local assistance. I think it's difficult to be, for example, for us, we are looking at German opportunities. I think we'll be doing fine, but really to be like a regular investor, especially on a buyout side in Germany, we need to have a German office and we need to have a German team, etc., etc. That probably it requires a scale. And then if you look at the, let's say, opportunities, why to do this if you have such a great market in Central Eastern Europe? Yes,
that's true.
That's first. We have to have a product. Then, in terms of the investors, I think there is a lot of LPs locally. I think it's even too much, honestly, because it's helping to create competition to us. That I think there was a good funding on the public market. I think there's a lot of initiatives right now to stimulate, I'm talking about the Polish market, to stimulate this innovation financing for early stage of venture capital. Probably Polish market will be the biggest number of VC funds per capita in Europe. Yes. But I don't know how we'll produce IRRs on the early stage, but there is, I think from that perspective, I think Poland was always relatively liquid in terms of venture early stage financing. For many years there was over liquidity in a mid market for private equity. Finally it's okay, I mean, because the market's consolidated, there's probably like 4 or 5 survivals in the mid market of private equity, which is good for them because there's, let's say, less competition. And then again, there is a lot of, I mean, usually the European funds are, if they're looking on Central Eastern Europe, they prefer to look at through Poland or Czech Republic because that's two economies that are the largest one. And they also delivers the highest liquidity in terms of exits from the investments. That will be, and even with the local funding, I mean, the programs which are currently started by the Polish government is like, I think, few $1 billion which will be financed to the venture or around venture funds. Most of them, they require us to do the funding outside of Poland. Yes, that's pretty interesting. Yeah. Mm-hmm.
Yeah, I mean, I disagree with you. Competition is good. It keeps you sharp and it keeps you always improving. So we have that on the advisory side all the time. We need to pitch all the time. So actually, it's good that the funds also have some competition. Jan, we've covered now the inflow of the money. Maybe you want to spend a little bit of time on the outflow of the money. What are the sectors where you see the coming time the biggest opportunity? Is also kind of independent of the economic environment coming up. I mean, it's a diversified region in both ends, so therefore also within those regions, which sectors and which places are hot for you at the moment?
Sure. I think this is another place where those sectors and regions would be obviously a bit different between DACH and CEE. I think if you look at DACH, what's happening increasingly is, historically, when you were splitting into sectors, either in investment banks or private equity firms, you were thinking about there's the services sector, TMT sector, industrial sector, healthcare sector, consumer sector. Now, what you have in the name, even in the names of these sectors, and when we talk to the investment bankers, you increasingly hear that it's tech-enabled services, industrial technology, and basically there's the lines between the TMT as such and any other sector are becoming more and more blurred. So what I think is, what I see is happening in Germany is that you're actually, considering also the amount of intellectual property which is generated in the German-speaking area, you're more and more moving toward businesses that are trying to solve the same issues that they were solving historically, but with more of a use of a technology than before. So it's, I'm wondering, well, 10 years down the road, whether there's going to be a separate TMT sector still at investment banks, because the more you look at it, the more there's this constant interdependency of the technological progress and other niches. So that's what I see in Germany. Now, when you look at Central Eastern Europe, I think the trends are a bit different. So what's happening is that the reason why the tech is so important for various industries in German-speaking region is that a lot of business is generating there through B2B type of places. You have very sophisticated companies, they need more and more services, more and more development on the B2B end, and people are relatively well off. They cannot really consume significantly more as such, and then have reasonable savings. If you look at Central Eastern Europe, people are still on the pattern to increase their personal consumption. So the type of businesses that are growing, and you actually even see it in transactions, these are very consumer focused, and I'm not saying consumer just that they sell consumer products, but basically companies and industries which are focused on consumers. Just looking at the last year, or like last 2 years, the major transactions in the region, like you look at Profi and Dino retail chains, yes? You look at Żabka, another retail chain in Poland. You even look at Allegro. Allegro was, it's technically a TMT asset, but the fact it grows is driven by the fact that you have basically consumers buying the products and a switch from physical network to online marketplaces, but same trend. So I think that's this is a bit of a difference between these regions when it comes to the assets, and it's unfortunately underpinned by the fact that there's less of sort of tech-based intellectual property that you can successfully commercialize generated in Central Eastern Europe. I know Tomasz would probably not fully agree, considering he invests in tech, but but the commercialization of your IP is not really there. So yeah.
Okay, no, very good. So you have more the IP-driven, DACH-oriented investment opportunities, and you have more still the consumer take-up of the consumer spending driving the CEE investments.
Correct. Correct. That's how I see it. Yes, but
yeah.
It's hard to really say which sectors are fastest growing in a particular place, because these are typically sub-sectors and macro trends that sort of drive it.
Yeah. Will, what can you add to that?
Well, I think a different perspective, because we are in the much less exciting areas than these guys. We're in the for our first fund, we were infrastructure and manufacturing, and we're much more steady growth rather than spectacular growth sort of people. But I think even in our areas, there are good signs for growth in CEE. Manufacturing, I mean, the region still has a significant cost advantage for labor. It's very high quality labor, and so I think manufacturing is doing very well. A lot dependent on Germany, and if those of you from Germany, I think we in CEE thank you for the continuing economic powerhouse that Germany is. So long may that continue, and as long as it does, I think manufacturing in the CEE has a very good future. On the infrastructure side, one of the areas we looked at, we did a lot in renewable energy. It depends, historically it's depended a lot on government subsidies. That varies a lot country to country in Central Europe, and you get some countries that seem to have a good arrangement and good subsidies, and then the politicians change and the arrangements change, and that's a risky aspect to it. However, we think there are still good signs in renewable energy. I mean, the two particularly interesting areas for us are one in the south of the region, the warmer areas. Solar PV is starting to become economic without any subsidy at all, and I think that's a very interesting area. The second thing that's happening is that there are new arrangements for being able to produce renewable energy in one country and sell it on a market and give the quota to another country. And so I think Holland is starting to have arrangements with Central Europe about Central Europe getting their quota for renewable energy, and that's very interesting. Another area that we like in the infrastructure is municipal lighting. Well, the whole of the lighting industry. So the conversion from old fluorescent lighting to LED lighting, where there's a very big cost saving to be made by converting, is a good and interesting growth area. And then in our second fund, we're going to move into one new area, which is agriculture and food. And I think there are three drivers in CEE to this. One is the general world situation, growing population, increasing affluence, and therefore spending more money on food. There are some parts of the region which are very big exporters. I was talking yesterday about Romania, arable grain. So 90% of a very large grain crop is exported from Romania nowadays. There's very big efficiency gains, and there's the increasing consumer affluence in our own region. And so I think for us, that's a good steady growth area.
Okay, I'm gonna jump a little bit in the questions around, and basically also ask the floor a little bit, because it's a topic that I think everybody is at the moment kind of observing. Are valuations too high, and are they reaching again too high levels. I mean, believe it or not, as advisors, you don't even like it when it gets too high again, because after the party there comes a big fall, and then it normally takes a couple of years for everything to recover, because everybody remembers the valuation that he could have gotten 2 years ago, and is not willing to adopt very early. So although everybody is enjoying the party and obviously likes to see good valuations and outperforming the valuation expectations when you sell companies, at some point you get a bit worried about is there too much lending again available? Are we seeing deals that somehow you have the feeling this with the economy turning a little bit, they will get into trouble and banks will start pressing them. So what does the panel see on this? I think this is more an open question for all of you, and I think also for the floor this is an interesting question to participate in. Pekka, you want to start?
Thanks. So the real question is, am I selling or buying? If I'm selling the companies, the valuations are always, of course, too low. You know, we should get a lot more money for the good companies. If we are entering, it's always too high, because the entrepreneurs are too greedy, or the small funds want a big markup and so on. I mean, we always talk to the small funds that, wouldn't it be nice that you actually have a fair value so we can all make money together and not just pump the price for the next guy coming in? But seriously, who actually, if you talk about valuations, who knows what have been the highest valuations or biggest exits of private equity and venture-backed companies last year, either across the DACH region or the CEE region? Anybody, any big exit numbers? I mean, there were the retail chains. What was the headline number? Profi was sold at, anybody remember? €1 billion. Sapka, yeah? Anybody else? What were the biggest exits? Allegro at 4 billion. That's probably the largest. What was in the venture space? The biggest exit out of the Germanic or CEE region? Well, when was the whatever Talking Tom sold? That was $1 billion something, but there was no venture fund. The Slovenian, Seven, the little app of the funny cat, that went for $1 billion or $1.2 billion.
Czech Republic, API,
yeah,
sold to Oracle, 40 million euros. 40
billion.
Million.
Okay, I thought 40 billion. Oh. That's a big number. Yeah, that's a good number.
Represent, wasn't it? Yes, Slovakia.
Okay. Anybody else? Any idea about bigger things? No? So probably, I mean, there were hundreds of exits, and I think a lot of people made hundreds of millions. But the point is that we still don't hear enough about the success stories. And this is a problem for our industry, it's a problem for the entrepreneurs, because you need role models. We all want to see successful entrepreneurs who put their life 5, 10, 20 years in building a big company and selling it. We need that, and we need to become better in celebrating that. You know, in very few countries, they do a good job in this, and that's something that, you know, people are rather modest and, you know, don't want to talk about it, and it's news today and gone tomorrow. But we all need that, because that feeds the industry. That gets the best people in the building company looking for money and spending years and years and years in building something. So no matter what the valuations are, we need to celebrate the big exits.
Okay. Tomasz, you're buying a lot lately, yeah. So how do you see it?
Selling a lot too. It's probably more selling than buying at the moment. But no, we think that first you need to have a tactics on that. That for example, one of the tactics we have for many years, it's very successful, that we try to take over the national champions in a small CEE countries, where usually is a limited demand. Because, for example, for Czech Republic, for Hungary, Even for Poland, if there is a single country champion in digital economy, there is a very limited demand for such a player, yes? And then we try to roll out that and make that a regional champion, that basically increase the size of the transaction from the exit perspective, increase the amount of potential bidders, yes? And basically it's all about getting to the European level of private equity funds and getting to the, let's say, global level of strategic buyers, because then they are really, I mean, bigger is better in terms of the valuation, yes? That's one. That always we try to find how we can transform the valuation from a lower entry valuation to the higher exit valuation, yes, in terms of the absolute multiplies, yes? Not always works, because sometimes I just was talking about an example of the payment company, which we bought for 30 times EV/EBITDA and will be selling probably 15 times EV/EBITDA, but EBITDA grew up 10 times in the meantime, yes, which is okay. And another, I think right now valuations are pretty high in Western Europe and for the buyout asset, and the US is particularly high. I think it's like the average EV/EBITDA valuation, buyout valuation for US is for last year is like 12. It's very high. That I think probably we are end of the cycle this time US. I mean, still there is some space for the cycle in Europe, but Central Eastern Europe wasn't so high because of a couple of factors. First, there was a huge reform of pension funds in Poland, which basically destroyed the IPO market in Poland, and that was a kind of factor which really make the local Polish valuations quite high, and that really helped to bring down the valuations. Of course, also you had to change the way you exit the asset because IPO exits stopped to work for many of the funds. Second, there was also a lot of kind of stressful events in terms of politics, which makes investors much more careful. Especially, I'm talking about Poland, Czech Republic, Hungary. I mean, lots of private pockets started to be more scary. That also helped to, and also some entrepreneurs started to be more stressed, willing to sell companies with less demanding expectations. That was also, that basically we've been isolated. That, for example, we've been investing in Russia and in Turkey, and Central Eastern Europe and Western Europe, and we figured out that why we should take a risk of Russia and Turkey, where we have, let's say, in general, much less risk in Central Eastern Europe, and valuations are the same or lower. Yes, but basically we figure out this is really like a phenomenon. Yes, you have a Russian and Turkish discounted valuation in Central Eastern Europe without the risk of Russia and Turkey. I hope, yes. This is the situation. It's slowly growing, but it's still not bad. I think we still have a very healthy market, which is in kind of balance. Where was the problem was the growth capital in Western Europe, for sure, and that was the same problem as it was in US 5 years ago, but I think it was also corrected. I think right now I believe the mistakes was done like 2-3 years ago, and right now they are getting back to the reasonable valuations, and this market is not overpriced. That I think it's rather buyout valuations in Western Europe being high, growth valuations are corrected. Early stage is always difficult to understand. I don't understand the early stage valuations. That's my view.
Yeah, no, it's very good input to have you explain the niche strategy. I mean, Jan, I think you're given the size of your investments, you're much more involved in structured exit processes, right? I mean, that's just the type of deals you're doing is preconditioned almost for that. So, are you worried about the valuation levels at the moment?
I think it's, if I look at the last 7-8 years, the valuations kept on increasing. So what you observe is that obviously there are some companies we looked at back, 2011, then they came back to the market a few years later, and they were traded for 2 turns of EBITDA higher, and then they probably will come back to the market again in a year from now, and then probably today the valuation would be again a turn higher than it was 2 years back for the same assets. Because that's the trading between the funds is something that you also keep on seeing. Am I worried? Obviously yes, because you're right now investing the fund. You're investing it at pretty high valuations, and considering that's the longest period of positive GDP evolution, I think both for sure in US, but I guess also in the Eurozone right now, in Germany for sure. It creates some risk because there has to be a correction. But what you've seen and I think that's the benefit of private equity as an asset class versus asset classes more depending on public markets, is that you can sometimes hold an asset for a bit longer. It's not good for your IRRs, but if you look at the funds from which were vintage 2006, 2007, investing at very high valuations and then going through incredible contraction of multiples in 2009, end of 8 and 2009, still many of these funds managed to, as long as they survived sort of the decreases in the economy, most funds did, they managed to hold it to those assets for a bit longer and still generate reasonably good MOCs, unfortunately holding the assets for a bit longer. So there, I think PE has seen cycles. Cycles will continue. Technically, obviously, you make more money if you buy cheap and sell high. So we'll look at vintages from 2009, and these are great vintages for funds. Yes.
Yes. I don't think anybody will ever and consistently sell at the top and buy at the low. That's almost near impossible. But I mean, we have, after the crisis 2008, we have seen some interesting examples of companies that bought and thought that they had done conservative leverage at 3-4 times EBITDA, and a year later they found themselves at 20 or 18 times EBITDA back, the same company. So that's and then it's good if you have the longer term perspective and you can work it out over time. Bill, the last topic also for you, this valuation question. I think then we open the floor for questions, and unless somebody of these questions should absolutely be addressed.
I mean, I think this follows on from one of Tomasz's points that, I mean, we look on it very much on a country-by-country basis. The CEE region is very different. You've got at the one extreme, you've got Czech, which is almost, we think, the same risk as Germany, Austria. At the other end, you've got the not yet EU members of former Yugoslavia, some of which are really quite risky, and so the multiple has to be looked at in relation to the risk of the country. We think. So yeah, on paper, some of the things in Czech are beginning to look a bit overvalued for Central Europe, but I think there are still good investable companies there. I mean, the one that I think is, in our view, is getting a bit toppy is Romania. There's some quite high, there's still quite a bit of risk there, and there's some quite high valuations.
Yeah, it's a big country, so that's why they always want German type valuations in Romania. So anybody that wants to ask something to the panel? Well, unless I get to good questions, there's no cocktails, as Pekka is saying.
Thank you very much. Tomasz Bobek, Erste Asset Management. You mentioned quite in the beginning that regulation has to be removed in order to get LPs, investors acting. In CEE, do you see any country having the tendency to remove or loosen regulation?
It's of course a bigger topic. I think it's populist to say that we will remove red tape and make it easier and so on. And again, I think I have been this week alone at 3 different notaries signing papers. I mean, it makes no sense. I mean, it's in a small scale, but makes it very difficult if every share transaction has to be notarized. Why on earth? I mean, half of the world doesn't need notaries. Why do we need it here in every country, and they make money? Again, wonderful job if you have been waiting 30 years to get the notary license for the first district in Vienna. It must be a killer. You do nothing, you sign the papers and 5,000, 10,000, 50,000 euros for it. But ridiculous. Red tape, just nuts. I don't think the notaries will go out anyway. Even if blockchain is there, and you could actually do it a lot easier, but notaries are needed for whatever reason. But that's not really the investment regulations. What there is ridiculous, like the Polish pension funds corridor, where they get punished if they can provide NAVs that are marked to market, for sure. I mean, it's plain stupid. It's very clear that in other countries, like in Sweden, where a lot of EQT's money comes from, or the Nordics overall, or Netherlands, pension funds need to make money in order to pay the pensions. And you need private equity allocation that can be anything from 3% to 10% or even 20%. You need it, otherwise you will not make enough money. I'm sorry. That's the reality of the planet. And this type of corridors that you force pension funds all to do the same thing, I mean, it won't work. It doesn't work anywhere. And this type of regulations, I don't know if there is political courage to change things, but at least... What? Yes, but they still act like it would be there. Now they are rather looking at each other and, well, if you don't do private equity, I don't do. But if you educate people 10, 15 years that way, that... Yeah. Exactly. So I think it will change. Some countries, pension fund has been more free to do various things over the years, and also, unfortunately, now there is more and more talk about nationalizing pension funds further. So I don't know if that's going to help at all.
Bill, you wanted to add something?
I mean, the one, and I haven't got any personal experience, but people talk about it, is Estonia, where, I mean, they say that everything that the government is involved in is now digitalized. You can do everything on a computer. You don't have to go to an office for anything. But as I say, I haven't got much experience of it.
By the way, if somebody wants to see that, you can become an e-citizen in Estonia. If you haven't done it, I would encourage you to do it, just for the fun of it. So you go to there's an e-residency site from the government in Estonia. You can sign up and you become an e-resident in Estonia. So, for example, I don't have to go to a notary in Estonia because I can use my electronic signature from here to do deals in Estonia. But it's pretty cool how they have done it.
Yeah, digitalization will make an effort and will make an impact on those type of things, absolutely. Thank you very much for being here today. Thank you very much for coming. I think we have 2 applauses to give. One is for Valerie and her team for organizing this conference, and the second one is for these guys. Thank you very much.